Buddy, it's Fausto from Cybertrain University, and welcome to the Cyber Trader podcast. I got one of my favorite guys I haven't had in a long time. One of the top gurus I would probably say in the industry. He's been great for the industry. Always been helping out with great content, everything else. Serge, how you doing?
It's good to
How's it
see
going?
you.
Good to see you too.
When's the last time I saw you? It must have been in Vegas.
Was it Vegas or were you in Florida? Did I see you in Orlando? I mean, in Florida.
Maybe that's possible. Yeah.
Yeah. Those were some good times that we had in the Vegas, and it wasn't just about the gambling and stuff, or going out and going to see the shows and the dinners, but it was just nice to have those events of meeting and talking about trading and having us all there to meet and talk about it. And that's the great thing about being part of that whole little crew. But Serge, so what have you been up to? How's everything going on your end?
Yeah, I mean, pretty good. We've seen this market, continue to kind of get the perma bulls more bullish. And so I think, on our end, it's been good trying to keep people from riding that wave, keep them to continue riding the wave, I should say. But at the same time, maybe also, letting them know about some risk management here, because it didn't go on forever linearly, right? So we'll see where it goes, but it feels like we're getting a bit long in the tooth here in many ways, not just in the market, just also from a sentiment perspective, from an industry perspective as well.
Have you seen a change that's been going on? Because like a lot of people, I mean, listen, the Dow's been breaking all-time highs, right? S&P broke all-time highs. People are like, where are we going with this? Is it too late to jump in? Is it like, have you seen any types of changes? Have you changed anything on your aspect of trading? You know what I mean? Or perspective of trading? Like, what are you teaching your students?
Yeah. Yeah. So I originally come from more of the investment banking side of things and the institutional side. And so one of the things that I have been spending a lot more time on over the past, I'm going to say 4 years, because it was still in its infancy in many ways when I left on the institutional side, 15 years ago. And that's really the algorithm stuff. And, if you look at the algos and the advent of AI, a lot of it's becoming more momentum focused. I don't know if you, and I'm sure you focus on some of that too. I would be surprised if you're not, but the algos are really looking for momentum. Not all of them. There's obviously the ones that do counter trend and they slam you, but there's a lot of momentum. And I think I've been trying to get people to understand what that means, how much that can help us, but also because we live in this day and age, as you kind of alluded to, where there's like the unlimited bid. But that unlimited bid can flip at some point if the algos decide that things are now different. So I think momentum is becoming really, really important as a strategy to do, not just from sort of an intraday perspective, but also, when it comes to even portfolio management, there's so much momentum stuff that we need to respect. And I think that's new. I think that is something that's changed over the past number of years. Actually, it's slowly been changing, but more and more so.
It's funny you bring that up, because I just came back from Toronto. I did a money show event. It was over the weekend. And that's specifically what I kind of focus on teaching people about, on the momentum part about it. Just follow those algos. Like I did an event, machine versus human. I'm actually tomorrow, I'm going to the NASDAQ Center. They're doing this whole big thing about AI trading on NASDAQ. I'm really curious on how NASDAQ is now implementing AI into it. But yeah, I think a lot of everybody needs to understand, and that's why I like having you on. And I think you, out of all the gurus I know in the trading industry, you trade very similar to a little bit like the way I do it, by following the momentum, by following those high frequency trades. And it's funny, when I was in Toronto and people would ask me, like, why are more people not talking about it? Why didn't they explain it? I'd be like, well, like, where'd they come from? Had the guy learn how to trade? Was he, you see these people, Serge. Some people are gym teachers. Some people are just, nothing wrong with that. But like, they're not traded. They worked on the floor. They don't look at the orders. You know what I mean? And that's where, like I said, where I think you and I have so much in common on that type of trading, because you can apply that not only on the day trade aspect of it, but also on the swing trade aspect. But getting a little bit more about yourself, like you being, being in the financial industry for so many years, what made you get started and building the steady trader? How did that all come about?
I when I left college, I started working for Bloomberg, uh, and then I went over to J.P. Morgan. It's a long story there in between. I'll spare you the details, but and I went over to J.P. Morgan and in Manhattan, and then at some point they found out that I speak Swiss German because I'm
Uh-huh.
also Swiss, and so after a couple of years, they said you should go to Zurich. I'm like sure. So I went to Zurich and I started writing this morning letter because when you're working on the trading desk at an investment bank, you get all this research in house and you disseminate it to your clients. But so being sort of the American guy on the desk, and we would get all this research. I thought I'd kind of put kind of like a pop culture kind of fun spin on it,
Hmm.
and because it was so that research can be so boring, it's like the short end bonds research guy who can, it's unbelievably boring. And so I kind of started writing this morning letter, and on the Bloomberg terminal, you can check how many people open that message. So
Hmm.
like literally 2 years after writing this thing, I checked one time, did a stat of how many people are opening this thing. It was like 90% of people were opening this. And these were like, CFOs of like the huge insurance companies and like UBS. I'm in Zurich right now. And they were opening all this stuff. I'm like, man, this is pretty cool. And so I ended up leaving JP Morgan because in '09 because I thought, yeah, no, '08 because I thought things were about to get really gnarly, and as they did. So I moved back to New York and I started working for a family office, and I started writing this thing on the side, and just because it was fun, and it kept kind of being something that people wanted to read. And at some point, I noticed that there might be a business behind that too, sharing
Hmm.
all these ideas, and then it just kind of took its own thing from there.
So I get this question, and you get this question all the time. You probably know where I'm going with this, but if you're such a great trader, why do you even teach? You know what I mean? Like you
Yeah.
made millions of dollars. Like why you waste your time, doing this for other people? You know what I mean? So maybe you could tell everybody. I mean, I tell everyone my reasons, like why I can't. I like to give back to the market. Market was good to me. That's and it's the reason why I hate seeing people fail. Funny thing is, I tell everyone should do this. I just did this the other day. I ask AI, what is the failure rate of trading? Okay. If everyone has a chat GTP, just ask it and it'll tell you it's a 90% failure rate. And
Yeah.
and I know I just hate to see people lose money. But then when you ask chat GTP, well, what is the failure rate if I took training with someone, and it drops all the way down to 30-40%.
Oh,
Right.
wow.
Yeah.
I believe
Just,
that.
yeah, that just shows you. And like, but the reason why I like doing it is like to help people, like to teach people. Mark was good to me, and I like to train other people. But what is your reasoning?
Yeah. Actually, the story is really what happened. So I would continue to write this morning letter, and I realized over time that what it would do is it would keep me honest. And I was just sharing basically like it changed. The letter changed on the J.P. Morgan. He was basically just taking this research and kind of I wasn't allowed to give too much of my own view, but like the house view. But then as I left the institutional side and moved over to the buy side, I could give more of my own view, even right. But and as I was managing a portfolio for these people, I could really kind of be honest about my real time thoughts,
Hmm.
and real time not as in like intraday, but like on a day to day or week over week basis, and it would keep me honest to what I'm doing. And so, then at some point I realized you can monetize this, and I wanted to monetize it because I had costs,
Right.
and then it just snowballed into this whole thing. So I wasn't really doing it for the business aspect of it, just because it would keep me honest for everything I was doing on the portfolio side. And now we've got this business, and obviously this very well, but I also have an investment advisory firm, which is really where I focus a lot on. And so there too, it allows me to just be honest and open about and transparent about the research we do. So I'm a big believer in that whole, like you are too, obviously, you take a lot of risk by showing people your hand, right?
Yeah. Yeah. Well, listen, there's a lot of people out there that you have to, you want to build that trust with everybody, but that's what really makes, that's what I'm actually very proud of to do that. You know what I mean? I like to do that, which which it sounds like that's what pretty much what makes you really proud of what you do as being a trader and a guru in this industry. Is that the most thing that makes you, most proud of getting what you accomplished as starting the Steady Trader?
Yeah, I mean, I think what gives me on that side of the business, what gives me the most pleasure is honestly, it's just keeping people from doing silly things. I don't care very much, if they knock it out of the park right away. It's more about not doing silly things. Like I wish I could quantify this, and I wish you could quantify how much money have you saved your clients over the 20, I don't know how long you've done this now, right? It's been a
Yeah, it's
while.
been 30 years now.
It's
Over
been
30
30
years.
years.
Yeah, a
So
long
that's a
time.
lot of money you probably saved people from doing dumb mistakes. And not dumb because they're stupid, just things that you have with time that, I think the best traders, good traders know when to trade. I think better traders know when not to trade. It's that kind
Right.
of thing. I mean, would you agree on that, or
Well,
where do you?
I say it all the time. I tell everybody it's not about like I never listen. When I was 22 years old, I love bragging, right? But we're at an age right now. It's not about the winners. Everybody's biggest issue is it's controlling the losses. You know what I mean? That's what you're saying about saving money with people. I mean, we save people a lot of money because it's not about the winners take care of themselves. It's the losers. I have a lingo I always tell everybody. Most people hold their win. They sell their winners too soon and they hold their losers too long. You know what I mean? That's what you need to fix. And if you fix that, then everything else just just falls into place. But I think that's what I'm most proud of. Like today we did a trade in a stock and we just nailed it right at the resistance levels. And I showed somebody like you just said, like, look at the big iceberg order out. Look at this big order out there. Look at the algos. Let's get out and take the profit. And sure enough, it did exactly, what we said it was going to do. And that just comes with experience and time,
It does.
um,
It does. So I'm sure people appreciate that. I know you're always doing things live as well and showing your screen and stuff. I think that, that actually takes, I sometimes it's a little bit frustrating when people don't understand like how much you kind of, the transparency is really, it's quite a thing. It takes a lot to show all that. I think there's not a lot of people I know wouldn't do it.
Well, that leads me to that. I'm glad you brought that up because that leads me to a question because that's another thing that you and I and everyone that's on the show has this issue of dealing with. How do you separate from a person that they find on social media and look at these gurus and they have these big followings and think they're great versus the ones that you should, knowing that who's a fraud and who's not a fraud.
Yeah.
Like what advice would you give somebody? Because you train so many people and and I know we've trained a lot of these people that got ripped off from before. Like I took a class, somebody, I'm like, oh, they know they need education. I mean, listen, we all know we went to school and we went to college and stuff like that. But how do you know you picked the right teacher and know what you're looking for? What do you usually tell them?
I think it's a great question. So what I typically tell people, let's do some basic math here. So we're here in 2024 as of this recording. And we have now had a bull market for almost exactly 15 years.
Mm-hmm.
Okay. The average age in Wall Street right now is about 37 currently. So let's take 37, the average age. Let's subtract 15, which is the age of the bull market. That gets you 22.
Okay.
So what do people do at 22? Graduate college. Okay.
Right.
So basically anyone that's under the age of 37 has never seen a cycle.
Right.
They haven't seen one, at least in the
I've
United
seen
States.
it crash. Never, unless COVID.
No, not, yeah, okay, COVID, but I mean, that lasted all 4 weeks. I mean, that was laughable.
4
right?
weeks.
Whatever. That and a few $1 trillion, and it was all good.
Yeah.
But I think you do the math. So when you see these, and I don't want to get personal on this. Obviously, I'm not going to name names. I don't even know these people, but you see some whippersnapper sitting at the pool with his laptop screaming about a chart, and he's 27 or 30 or 22, God forbid, or whatever. He's anything under 37. He has never experienced a cycle. Yeah. The scary thing is, and I talked to a lot of people on the street, the people like that are now becoming more and more of the managers are now exactly that cohort.
Right.
and they have never seen a cycle. They don't know what the hell they're doing. I mean, they know what to do in a bull market, but I think everyone knows what to do in a bull market. It's not that hard. So I think just look for people who've had the experience, and someone tells you they've done it for 10 years. That means nothing. Like that means
Right.
zero. They've seen
Right.
nothing. They've
Right.
literally seen
Amen.
nothing.
Right.
So that would be my answer, the long-winded answer to that.
That's a
Does that
that's a
make
great
sense?
way of looking at it. I never really looked at it that way. I kind of just looked at it more where people, like, say, just, check out, look who their following is, see who endorses them,
No.
check the Google reviews, the Better Business Bureau, stuff like that. But there's always new up and comers. But you're right. They never. I actually, what's funny? I kind of do bring that, but I never really looked at it in that perspective. You're absolutely right. It's all about, they were never in a bad market. And I tell everyone, like myself, my problem is I'm just too damn conservative. Like I don't like to take chances. I tell everyone I was never a big trader,
Yeah.
and like, why? Then what do you mean by that? I'm like, I found my sweet spot, and every time I've been through too many catastrophes, and I've seen people just, that blew me out of the water. I mean, I had a friend of mine that I used to trade with. This guy was trading like 50,000 shares of Broadcom at the time. Putting like 2-3 million. I say I could never do that, But I'll tell you a funny story is that I'll never forget. We had this big correction back. It was down the financial crisis. It was 2005, and he came up to me. He's like, "Fausto, I'm thinking about buying a Ferrari," And I'm like, dude, you got like $5 million in the market. Like he's not even day trading. It's like swing trade. He's making a killing, And I'm like, and we had this big correction in the NASDAQ. I'll never forget. The NASDAQ dropped like 600 points, 800 points in a matter of like 2 hours. And this is when it was like 3,000, I'm like, you better hedge yourself, like buy like a put or something, whatever it is. And it was like $100,000 investment because, you just to hedge himself, because people like to trade options. Like that's when you really need to protect, your investments. More of an insurance policy. Make a long story short, he didn't listen to me. He went to go buy the Ferrari, and about 3 years ago, he was nailing roofs on my house. Paying him $200 a day. Just lost everything.
Yeah.
Because he never went through it.
Yeah.
So
No, and it's honestly, it's very dangerous. I mean, I will say, I mean, and I'm happy to come back to this point, but I was talking to one of my analysts this morning. He's out in California, and we were just kind of talking about this. And I think the way I said it is like ignorance is bliss, right? And so you have this situation right now, and that's kind of how your first question, how I'm kind of feeling right now. You see a lot of people feeling like, I think the biggest bubble we have right now from an investing perspective in particular the United States is we have a bubble in people's overconfidence in their ability to manage their own money. And because again, it's really not hard to make money in the bull market. You just buy. But at the same time, like you and I, we've gone through a bunch of cycles. Doesn't make us better people, just people who've experienced that before necessarily. But there is that problem that I have too, and I'm constantly fighting these demons where I'm too cautious, right, for certain things. But then again, I'm on research calls all day with hedge funds and family office and pension funds, and there's stuff we look at that most people don't even know what that is, and they're warning signs, right? But they see the 50-day moving average or whatever they're using, and it's off to the races, and it'll work, right, until it doesn't work. And of course, then you know what happens. They blow up 2 years worth of profits in about 2 weeks, and then it's all over. But it's really hard to explain people what that risk is, because they see the chart, chart goes up, everything's great. But underneath the surface, there's a lot of problems that are always there. And of course, our job is to make sure we're aware of which ones are potentially, eruptive and which ones are just dormant forever.
Which leads me to that next question people ask. So, being an analyst yourself, and and having these people you talk to, listen, we're going to an election year, all right? And you're seeing a lot of and one thing I hate about election year, you get these politicians, if you're on the left or on the right, they all want to give promises. Oh, I'm going to give you free money. I'm going to give you free this. I'm going to, give you tax. It's like, but what it does, it affects certain stocks. I mean, like some people don't realize it, but when Harris was talking, she brought up about, like, I mean, I don't know if she's still in it or not, but she was talking about healthcare, and I do a one-pay system. Meanwhile, the next day, I mean, listen, you love her or hate her. We're not going there. I'm just saying, as policy-wise, all the medical stocks took a big hit. Like all the insurance companies were down like 5%. You know what I mean? Like, what's going to happen if they could put them out of business? So there's a lot of policies that come along with that you have to be very prepared to. But with you moving forward, and like you said, we've been having a really big bull market. Is this bull market going to continue? I mean, yet tomorrow we have the Fed that's coming out that's going to projecting they're going to supposed to cut it the Fed rate, a 0.5%. But what have you been hearing on the street?
So from an allocation perspective, the smartest investors that I know have been basically rebalancing their portfolios dramatically out of mega cap tech. And we're talking about family offices that manage, 30-40 billion dollars, really like very smart, internationally diversified funds, pension funds in multiple states, really just de-risking or at least rebalancing. A lot of people have been scaling into a lot of the gold and gold miner stuff for a lot of reasons that goes way beyond the chart, right?
Gold is doing great. Growth like all-time highs. I mean, I own gold. I mean, it's at what, 2,600 now, something like that?
Doing very well. And again, there too, I think what I'm really seeing, Fausto, and I would love to hear your thoughts on this, but I'm seeing a lot an environment we're going into that is going to require an understanding of why things are happening, not just what is happening. And we've got an environment, we've had this inflationary shock, and we're firmly in the camp of that inflation is going to be somewhere between 3 and 5 or 6% for a longer period of time, as opposed to 1 to 2. That is a completely different portfolio. That also, from a trading perspective, and I know you're a big trader, that gets you into a different volatility regime as well. So I think there's a lot of forces now. The election years, there's a saying out there that says, "Don't trust any government data in an election year."
Mm-hmm.
You look at some of the revisions, 800,000 the revision the other month. I mean, it's insanity, right? So I think once we get into 25, we're going to see probably a more normalization of markets in terms of, it's not just mega cap tech stocks. We're going to start to see, 30-40% of the US equity market is tech. If you add it up truly, we're going to start to see that normalize. And again, that's going to cause a lot of shifts as well from a trading perspective, where the new momentum in growth stocks will probably be things like energy stocks and not the 5 stocks that carry the whole market for now 10 years.
The fabulous sevens or anything like that. So is that where you think where we're going to be going to? You think like, as some people should be looking into, is more into the energy market, and that kind of a stock market?
Well, that's a long-term theme. I mean, that's, again, we're, yeah, I know you're
and stuff like that, like all those, like, EVs and stuff. You think that's going to still, because there's a lot of those stocks took big hits.
Yes.
And what some of them have had business.
And that's been a great story. The Wall Street, is the greatest, sales machine there is. I mean, I can tell you that firsthand. And, you look at the, you look at the ESG thing, that whole movement. I mean, that was nothing on the Wall Street side. They were salivating over that 10 years ago when it started coming out. It's like, oh, this is going to be great. We're going to be able to put a little green tree on our fund, and because we're only investing in stocks that are not harmful to the environment. Apple's in every single fund that has that sticker on it, like 10 times over. So, and there's a lot of concentration risk as well, right? I mean, we all know that in the passive investing bubble and the self-directed investing bubble, I think, is very severe. There's one thing, and that's one thing to trade. And I know you're focused on the trading stuff, and we do a lot on the education as well, obviously. I have no problem people trading some of their accounts. Where I think people really overestimate is their ability to manage their own money. Like their big nest egg.
Yeah, you think I don't.
You know what I mean? I think there's a huge, and I think, and unfortunately, due to the passive investing, thing with ETFs, and I love ETFs. There's nothing wrong with ETFs, but as it's a byproduct of that, the Robinhoods and all things, people are no longer seeing, where they can't distinguish the difference between their trading account and their ability to manage all their money. There's a hell of a lot of stuff that goes into managing money. You really have to see the big picture, not just the chart. That's a big concern I have. I don't know if you have any views on that, but
No, everybody, listen, that's one thing I don't like. Everyone keeps focusing on the charts and everything else. They don't realize that, like you said, that you should have you play money, and you should be able to learn. Because let me tell you what I've learned as a trader. Before I was a trader, I was a broker. And if I knew what I knew as a trader, I would have been the best broker in the existence, because now I know a little bit more about how the market actually works. I know how brokerage firms make money. I know exactly why they tell you that they're pitching this stock and don't want you to buy this and sell that. You see where they're on the bid and offer. That's where all the high frequency comes in.
Yep.
And the orders. I mean, that's why there's a small group of people in one room in the trading department. You got hundreds, if not trade brokers on the outside. So I understand the whole concept of that, but it's been a challenge. But like, I think every time I do these events, even with guys like you, I learn something new on a different perspective, because people, yes, they should have their own big nest egg controlled by somebody, because it is a lot of money. I mean, you probably know this too by teaching people. I know a lot of people, like, they finally able to trade their money. They finally allowed to trade their IRA. They're at that age. They have, and they, and you can't live off that. You got to build on it. You know what I mean? Like, I mean, you live in New York. You know how expensive it is to live here? If you make $250,000, you're on the welfare line. Okay.
That's
Realistically,
incredible.
I mean, you're lucky you could probably have 2 cars, insurance. It's not cheap living here, but you can blow through that money like that. You got to
You
build on
can,
it.
but on that part, on that point, Fausto, and I hope everyone listening here and I mean this very sincerely. There is a um, when I look at people's portfolios, and we look at, this is on the investment advisory side, not on the education side. I've got two companies there, right? But when we look at people's portfolios, what I see is them really treating, and this is a lot of these people, as exactly you said, they start to retire, or even before retirement, right? They want to
Right.
start learning how to trade, and that's great. I mean, obviously, both you and I, we like, that's a great thing to do.
Right.
But I see people's portfolios are no longer portfolios. I mean, I'm telling you, 9 out of 10 times, they're basically just a bunch of stuff that have no reason of being in any existence together. And it's basically a bunch of tech stocks, US tech stocks, and not like the Nvidias in the world. And, that at least there's a quality company, but a lot of stuff that they read about somewhere and decide to put in a portfolio. And
Right.
what these people don't
I hear it all the time.
Exactly. And right now, that's okay. Everything's still, the charts are still going up, right? Or not everything, but, the indices. And so people aren't really concerned about it. But I'm unbelievably concerned about what happens to that cohort. That's the retirees, right? They cannot afford another 40% drawdown. And
No, they can't.
unfortunately,
It's a lot of money.
sadly, please.
I know, say it's a lot of money. People realize you work your whole life for 40 years to get there, and you could lose it in one trade. You get stuck in that thing.
Exactly. And they don't understand the risks they're taking. And a lot of these people are very smart. We're talking to very educated people. These are not people who just don't know anything about numbers, right? And so I'm very concerned about that. So I love to teach them on the trading side. It's fun. There's a lot of stuff to do. But I really always make sure I have an idea of what they're trying to do overall, and not treat, it's one thing treating a trading account as entertainment. I mean, that's not good. Obviously, I'm sure you and I would both not advocate that. It's very serious business, but most people won't trade with all their money, right? But if you treat your 90% of your nest egg as that, and you're not aware that you are, they don't mean to do that, but they're just so enamored by this bull market that there's no longer portfolios. You talk about 60-40 portfolios, and they sneeze at it and, swim across an ocean before they have to hear more about it.
And that's where now all of a sudden becomes gambling. But you know what?
Yep.
Why don't you show us a little bit about that? Could you share your screen and show exactly these mistakes that people make? Because it's not about the winners, like maybe we should educate everybody a little bit of what you're basically talking about.
Sure. Yep. Let me quickly share my screen here. I could figure out how to do that. Is it the plus button I have to hit, or let's see here?
It's the it says it's the middle one that says share screen.
Yeah, screens. I got it. Yeah. Cool.
Yeah, and then all the way to right says entire screen.
Yeah.
To pick the screen.
Got it. I mean, like that big picture stuff is to me is more about just understanding what are the trends, right? So, like, I just like to make this is very simple. This is just the chart stuff, which is important, obviously, very important.
Mm-hmm.
But I need to know, like, what are the different sectors doing? Like let's just keep it to S&P centric, chart stuff. Like I need to know which sectors are bullish and which ones are bearish. So like right now we have an algorithm that tracks different sectors and different asset classes and of course different stocks and futures and all that kind of stuff. But I don't know how you fall into this, but like I like to differentiate between a trade and a trend, right? So like when you do a day trade, like that has very little, if actually has nothing to do with a stock's multi-month trend. I would imagine you'd agree with that, right? It's just a trade, but I need to understand what what the trend is first and foremost, because there's a lot of stocks that people buy and they have no clue when that trend is starting. Like, is it actually in a bullish trend? And more importantly, when is it maybe ending? So like, one of the things I always tell, a good example is like PayPal. Like I can probably bring it up here, show you. Like this is one of those stocks. It's now actually gone back into a bullish trend, but just to give like a small idea of how this kind of worked. So we basically distinguish between trends. The red background color is a bearish trend. The black background color is a neutral trend, meaning there's nothing to do. And the green background color, of course, is a bullish trend. Right? And there's trading signals along the way, but I need to know what's the trend. From a portfolio perspective, that's important. From a trending perspective, from a trading perspective, I want to know that too, because I want to kind of go with the trend, if I can, unless it's a counter trend trade, of course. But like, for example, so this guy, PayPal became a bullish trend in April 2020, right? COVID.
Right.
Stock goes from 71 to whatever, 308. And then around the 265 mark. So it's gone from whatever, let's call it 100. Yeah, no, $100. So at 270, it finally no longer was a bullish trend. Started breaking that trend, neutral trend. But at some point down in the 70s, down from 280, people are still holding on to their stock, believing in that long-term narrative, giving up all the gains because they don't understand when the trend changed. So from a trading perspective, that's okay if you're in and out all the time, but not understanding when the trend changes is horrible. And then it goes into a bearish trend, right? And then of course that just basically, the idea is if you're in a bearish trend, the odds from a swing trading perspective are better to just short or buy puts or whatever. Whereas in the bullish trend, you want to buy calls or whatever you want to, or whatever you do, right? Credit spreads, whatever one wants to do. So that's the long-term stuff. And then the momentum stuff, which we talked about before. And actually, I'd love to hear what you think about this momentum stuff, because we talked about it, right? Like I just brought up one stock that everyone knows, ARM Holdings. It's semiconductor stuff. Like this is the daily chart. We could look at intraday. It's the same exact thing. Just forget this could be 5 minute, it could be a whatever.
Okay.
So what I found a lot is that the momentum stuff that we mentioned before, the algorithms that focus on momentum, they actually focus on pretty simple things. Not all of them, of course, right? It's an infinite thing. But some of them keep it very simple. And what happens is you only need like one or two big algos to focus on that. And then other algos pick up on it. So like, for example, at this point there, this was in May, right? So we got a new momentum buy signal. This is a simple moving average crossover system. Call it simple, but it's actually unbelievably effective. Like uses on the S&P 500. And I think this year we've had like 4 signals and it's just awesome. And so you get that and momentum holds, and it tends to hold this purple line as support, as a trailing stop, for example. But again, it's algos become, when algos pick up what other algos are doing, it snowballs, right? And then you get a sell signal. So this thing went from whatever there to the trailing stop loss would have been about a 44% gain. And then from the bearish signal here, to the ultimate trailing stop was about 12%, but typically go for like 10, 15%. And now we got a new buy signal a few days ago. So that's the momentum stuff, right? But when you look at momentum, like is there anything that you found specific that's like interesting or new?
Well, the only thing I would look at is like more or less is just follow the big block orders. And like, and one of the thing like I saw, like seeing on your trend right here, is I see something we call, which is called a higher low.
Yep.
I mean a lower high when you have the
Okay.
stock peaking up, and then all of a sudden it never makes a newer high. Yeah, right in the middle of your screen, right there.
Yeah. You mean
Yeah,
the
it's
lower
like,
high there?
yeah, right there, and then it's make a lower high, and then and that's one of the things that's alarming. That if you don't see that happen, because stocks always back off, right? I mean, it's always profit taking, and it's a good thing. I tell everyone, like, the market going down is not a bad thing; it's a good thing. You're always going to get, you need selling pressure. You want to see if there's still buyers out there, and when you have a situation like that, it never came back and broke the previous high, then that's where you get that big crash right there. And like, I'm a specific day trader, so is slash swing trading. So by seeing that as a day trade, you could see how that could trickle into a swing trade. And if you didn't see that, look where you end up a couple of days later. I mean,
Yeah,
boom.
no, exactly. And that's the thing, right? I mean, that's the point about the algos. Like the algos don't have any feelings. Obviously, they're machines, right?
Right.
And that's kind of the bringing it back to what we talked about earlier. The average age in Wall. If those people are just tuning in, we talked about the average age in Wall Street right now is about 37. We've had a 15-year bull market. 37 minus 15 is 22. That's when you graduate college. So most people, the average person on Wall Street hasn't seen a cycle. They've only known bull markets. And so a lot of algorithms are based on hypothetical stuff, right? With no real
Right.
world experience. Not all of them, of course, there's extremely sophisticated stuff. So I'm not talking about everything here, obviously. So you could imagine a situation where the algos flip and going from this endless bid to the endless offer, right? Just selling everything constantly. And I think that's one thing. The FTC, by the way, is quite concerned about some of these things, some of that, and some of the concentration of portfolios as well that I mentioned before, because you could have another Volmageddon like week, like not a day, but like weeks of Volmageddon. Like Volmageddon is when options have no more bid, you get the VIX
Right.
to 80, right? So, but momentum's interesting because you can make money with it, whatever the algos do, right? And the algos tend to be trending. They buy something, they rip it, and again, it's because the algos are cumulative. They snowball. When you have that momentum, it lasts for X amount of time, depending on your time frame, of course, and then it flips in the other side potentially, as you can see in this example.
Now, regarding about what you're showing right here, is this your specific software, or is it something someone gets on their brokerage firm or something like that? I mean, how does this, what
No,
exactly?
this is actually something that so when I was at JP Morgan and then moving on to the buy side, I was fortunate enough to work with a couple of really quantitative guys, and I'm not quantitative, I'm more qualitative, and then we kind of married the brains with the macro overlay people. And so we developed about 4 or 5 different things that we were looking at, and I was in the fixed income department, so we do a lot of credit default swaps and CDOs and all those things. And so we were actually developing this stuff for the fixed income derivative markets.
Okay.
And then as I started going to the buy side and then moving on, I started actually looking at how this is applicable to the equity market. And actually, interestingly enough, it's actually even better with the equity market because credit default swaps can be very volatile. So yeah, we developed this. And it takes a lot of trial and error to see like what are the algos actually focusing on. And the funny things about this is almost like a learning machine, I think of it like an AI thing. It has gotten smarter, or the machines have gotten smarter and picked up on this pattern.
Right.
So it's really interesting.
It's smarter, but you know what? But some people don't realize that technology's out there, and it's still going back to the old stuff. And that's why I love having guys like you on, because you show that we all kind of, like I said, I always like having you on and do an event with you because we trade very similar, following the algos and following that. And people are like, well, like, I'm going to tell you a stupid question people ask me: how do I know those algos are real? What do you tell?
Yeah, no, you want me to, I have an answer for it. It's my view. You want me to tell you?
Yeah, tell me.
So,
Because some
okay,
people,
so
I get
well,
all
so
the
here's
time.
what I say, and I would be surprised if you wouldn't agree to this, or at least to some extent. Not to put words in your mouth, of course. Look, 85% of the volume on the NYSE and other markets, like other asset classes, is algorithmically traded, right? Or automatically traded, at least.
Automatic trades.
Yeah. Okay. So like it doesn't take. I mean, even I can do that math. If most of the volume is automatic trading, by nature, any given move at any moment has a really high chance of having been an algorithm.
Right.
It's as simple as that. I mean, that's probably almost, I would say that's factual.
Well, like I said, well, the first thing I tell everyone, they're real trades. Now, the people could cancel them just like you could, but they're just orders that are out there. It's one of the reasons why some people don't realize that brokerage firms give free tickets, because they want all that orders to see where they're coming into, because to them, it's the biggest casino in the world. So if they know where people want to buy and sell it, they're really trading against you,
Oh
where
yeah.
it comes down to it.
Oh, and by the way, that just speaking to that, people don't realize on the street, like on the broker or investment banking side, how hard it is to make money on the buy side, or as your own trader. So like my little team at JP Morgan, which wasn't that little, but I remember the real core group of about 12 people. I remember about half of them, after they actually ended up getting fired after I left, because we had the great financial crisis in 08, 09, and half of them wanted to trade their own book.
Right.
Not a single one of them succeeded, because they were used to getting all that flow, right? And on the credit markets, it's even more important to have that, because that is all there is. Mm-hmm. So there's no price discovery, really. It's just that information. If you don't have that, you've got nothing. You're sitting there with you and your keyboard.
And if you think you're going to beat them, I mean, you're going to lose. I tell everybody, you just don't beat them. You could join them, and that's why you could just join them. What's the big deal? I mean, I tell everybody, Serge, we are the ants on the floor. We're just trying to get the crumbs. You know what I mean? Stop trying to think you, and I just tell them, just do yourself a favor. Don't even trade. If you think there's no feelings. You know what I mean? We're like professional athletes. You and I are professional athletes when it comes to this, and we get paid to win. We don't get paid to lose. But when we're competing against each other, it just comes down to, who's going to win, who's going to lose. And you don't want to be on that losing team. You want to be on the winning team, and that's what everyone does understand it. And, but it's okay. I mean, that's why we're here. I had a question right here. This guy, Samuel, has a question for you. I don't know if you see that. You see the question on the right he has?
Actually, I should probably bring up my thing. Is it under, let me see here. Oh, chat. There you go. I got it. Yep.
There's a quick question there.
Okay.
Make it answer them.
Sure. Let me just see here and read the full question. Oh, value stocks. Oh, yeah. So, I mean, we're going to run out of time here real quick before I go down this whole thing. So
we don't run down a rabbit hole.
Okay. So I'll do this. So I'm like I said before, I really believe that there is a misallocation of capital, trillions of dollars being misallocated right now. I'll try to give you this. I'm going to find a PowerPoint and bring it over here in a second. I'm trying to answer Samuel's question, because I think it's a terrific question. So the asset allocation, and this is factual, at least historically speaking, the asset allocation, like stocks that do well, to keep it simple, in a higher inflation environment, like 3 to 6% inflation, is a completely different different portfolio than what works in a 1 to 2% portfolio, and 2% environment. So, For example, value stocks outperform. They haven't done nothing for a long time, but we've had a 15-year raging bull market in a 20-year, 30-year, disinflationary environment. We first had the end of the Cold War. I'm going to try to find this at the same time while I speak, and then a situation where we had China, join the WTO. Those are extremely disinflationary things to happen to the world. And so, yes, I very much think we're going to be in a different environment. In fact, I'll show you this. Is that okay if I show this quickly?
Yeah, go whatever you want.
Okay.
I can bring it down so people can see us a little bit here.
Yeah. So I created this chart a few months ago, and so basically, so this is what I just said, and this is the pictorial form of this. So we've had this disinflation environment, basically the 90s all the way through during COVID. And so we're in a different era now. Now, obviously, inflation's come down, but I think core was 3.2 the other day, headline 2.8. We're probably going to go back up to 3.5, 4, 5%, and kind of stay there, maybe go a bit higher. We're just having the shock come off now. We ricocheted up, or we had a massive spike, and we came back down, but it's going to stay higher. And so value stocks are probably going to do really well. Now, the misallocation, and this is, by the way, if you overlay inflation over how the inflation tracked in the 1970s. So the 1970s inflation path is red. We're blue. So we've tracked it perfectly so far. So we're going to get another wave of inflation.
Are we
I'm
really?
not in the camp of seeing 10, 14%. That's not my point. Who knows? I'm more saying 3, 4, 5%. And again, it's a completely different portfolio. So, what about Nvidia? Look, Nvidia is a momentum stock, and it's become a bit of a, and I'm not meaning this derogatory because it's a great company. It's become a cult,
Yeah, it is.
and so that cult is dangerous from an asset allocation perspective
It's like
because
another GameStop.
it's another GameStop in some ways. And I'm going to try to flip this here. So I want to get to the point so I can show you this. Oh, here. Okay. Last point on my rant here, Fausto. Sorry, you got me going with that great question from Sam. So this is what we said before. So historically speaking, and this goes all to that whole inflation picture, right? This is now less of the trading side, but for trading, this is going to matter too, because there are going to be new growth stocks out there, and they're going to be in the energy space. They're going to be in the material space. I mean, we talked about miners before getting a bid, right? So historically speaking, the technology sector is closer to about 20% of the S&P. Right now, if you're true about it, it's about 40, 45, because communication services, guess what? Those are tech stocks.
Okay.
We used to have them called, that sector used to be called telecom. I mean, it was Verizon and AT&T and a couple others. Now that is basically Meta and a couple others. So those are tech stocks. Anyway, so energy right now is about 3.6% of the S&P. We have a historic underinvestment in energy. We need to get to this whole ESG thing. Like, if we want to be environmentally friendly, we have to invest a crazy amount of money in energy, like old like drilling stuff, just so we can get to the other stuff. Anyway, historically speaking, technology is closer to 20% allocation, right, in the S&P, and energy about 8 or 9. Right now, it's the exact opposite. So people's portfolios are completely offside. Like, I mean, it's and again, it may not matter if you're 25, but this could be, unfortunately will be catastrophic for a lot of people that are in their 60s and 70s because they're completely misallocated. So NVIDIA is not going to crash, I don't think, although the rate of change, Sam, you may have noted, the rate of change in NVIDIA is actually slowing. So they had their first slower growth rate, I think both top and bottom line, I believe, last quarter. So the rate of change is hell of a company, right? But then again, if the CEO starts signing bras and those kind of things, that's, I don't know. I don't know about you, Fausto, but that gets me. I've seen that movie before, But again, I'm not bearish in video. Let me be clear. I don't want to get hate mails here.
No, I got a lot of scrutiny myself. I actually posted a video on Instagram, which was like probably the most the most simple video I ever made. It got over 1 million views on the video. And I showed everyone talking about high frequency trades. I was showing them all the algos that were hovering around 140, 135. I mean, I was a big fan of it. I was on NASDAQ. I was talking about NVIDIA forever, talking about, people like, oh, it's a good company. I was like, it has nothing but a good company. People keep buying it. It's orders, orders, orders. When I showed the algos out there on the offer, everybody's like, you know what you're talking about? This thing's going to go up to, it's going to be $160 stock by the end of the year. And I said, listen, I hope you're right. I mean, for your sake, like you said, it's becoming a cult. I was like, but you got to get through that 2 million share seller out there first. They're like, well, the stock trades hundreds of millions of shares now, so it doesn't matter. I'm like, yeah, but that 2 million could be another 2 million behind that, and be another 2 million behind that, and another 2 million behind that. And sure enough, where'd it go? It went all the way down to $90. You know what I mean? Yeah. So, I mean, yeah, now it's spiking up. But like you just said, Serge, you're showing a list right here. There's just so many out there to choose from. It's all about, I try to teach, and I know you do the same. It's all about risking the least amount of money with the high amount of reward. You can't go out there and just trade it because it's NVIDIA. I got to trade NVIDIA. It's Google or Apple. There's 25,000 stocks out there, that are moving. But
yeah, but it kind of puts a bow around everything we just mentioned before, right? That's what I'm concerned about. I think from a trading perspective, a lot of people are, again, not understanding that there is a difference between, again, their trading account and their investing account, and that those cannot be treated the same way. But right now, factually, people are treating it, not everyone, of course, right? But a lot of people that are do-it-yourselfers are treating it the same account. That's where not only I have concerns, I know there's a lot of even government agencies that are concerned about that.
Right. Well, why don't you show us a little bit about how people could learn more about you, Serge, and tell them how can they get access to you a little bit more and learn more of this stuff? Because listen, we're going to some scary times, like you said. So it's very important that everybody knows to separate, who they should follow and what they should follow. Because I follow you all the time, and that's why I wanted you on, because we trade very similar. But you look at things a little bit more of a different perspective. The way you look at more on the broader of the economical way of looking at it. I just look at more on a day to day.
Yep. No, but I mean, I think there's, it does go hand in hand. Like for me, I want to understand what's going on for not only my big pile of money, but also my trading perspective. And like I said before, like if we start to see this shift, as I alluded to before, and we are seeing it, by the way, gold and gold miners and all that stuff, like the hard assets are starting to move. We are going to see a situation where the new momentum stuff will be different stocks, right? That's, again, I'm not anti-NVIDIA, any of that. I mean, obviously a hell of a deal what they're doing, and I think there's a big future, but there will be other things that are going to start becoming the new thing, and people are not prepared for that. So if you guys want, I mean, I have this this report. I can put the link in your thing here.
Yeah, definitely share it. Put it there.
Yeah. The link it's just a report you guys can get. Like, it's basically some of the top 4 things I'm watching in Q4, or top 4 or 3 things. And some of the things we kind of alluded to, I'll give you like my price targets and stuff like that. So if you want that, I'm going to give you the link here. It's the steadytrader.com/report. I'll put it in the chat box here. Does that work?
Yeah, just put it in the chat box, and then we'll post it up on the screen.
Gotcha.
Everybody can see there. Yeah, I'm gonna click on that, and then
I just thought I'd give you guys something so you can kind of get your head around, some of the trends that we're seeing, and again, it goes within that sort of broader theme that we just kind of mentioned. There's specifically 4 things that I'd like here, not only in the fourth quarter, but also well beyond that as well. So if you want to have a look at that PDF, I think it'd be very
everyone just take it, just copy that link, and if you are registered at Cyber University, we'll post it also in our trading room and everything else. But yeah, definitely get that report. Listen, great traders never stop learning. That's why I like to do these podcasts, because you get to hear a little bit of different perspective from everyone out there. But we all kind of pretty much trade the same, and sometimes you need to hear from a bunch of different people until you find what fits your type of a style. But yeah, so definitely take advantage of that. To go to the steadytrader.com/report. Now, I always like to go. We're almost done here, and I always like to go off and ask you a personal question and everything. And because everyone doesn't just realize we do have a life. We do other stuff here. So, regarding about yourself, Serge, if you were not a trader, what would you be doing right now? Where do you see yourself?
If I wasn't doing business anymore, in general, if I didn't have to work at all.
Yeah,
Is that the question?
like what's your hobbies? Like, what would you be doing if it wasn't for trading?
Yeah. If I wouldn't be doing any of this, I mean, mostly my hobbies are, I'm an avid golfer. I played in college and everything, but I'm also a big snowboarder because I live
Yeah.
between Florida
You do look like what's his name from the Olympics, the redhead kid. What is his name? The famous
Shaun White.
snowboarder, the one who wins all the golds.
Was Shaun White, but yeah.
Shaun White.
Yeah.
Yeah.
I appreciate that. He's not. He's since actually retired. He's no longer that young either. But no. But I mean, that's what I would do. I'm a big snowboarder and golfer, so I know that's fire and ice, right? But that's probably what I would do. When you play golf or when you snowboard, like there's not very many places you go to that are not nice.
Yeah.
So like typically, like there's beautiful golf courses where you live. I once had a 5:15 tee time out in
the Black.
Yeah.
That's why they have the U.S. Open at the.
Yeah, exactly.
Yep.
I mean, some of the beautiful places in the world. So same thing with skiing or snowboarding.
Good.
Yeah. What about you? What's going on with your the food hobbies?
Yeah, it's just I just love it. Like I said, I got my backyard chickens. I mean, awesome. I don't make girls. I have 3 boys, so I got a dog, female dog. My kids forced me into that. I went from like 3 chickens, and I got like 15. I got 2 cats. I don't know if you saw my couch trying to break in my room just now, because he wants a treat. They're all girls. So, but I just love cooking. It's a great hobby. It's one of the things that we do. I love gardening and stuff like that. So it's good therapy. Like I tell
Yeah.
everyone here that you should have a hobby. The trading is not a full-time job. People think got to be here all day, and I'm like, no, you crazy? Like you got to do something else. Got to clear your mind. That's why we love to trade, because if you know what you're doing, you can make a very good income doing it. But it's not a 9-to-5 job and stuff like that.
You got to pick your spots, right?
Yeah, you got to pick your stops. You got to enjoy life. Like I was in Toronto, I did a great speaking there. It's just go to some of the conferences, but also just do the things that you like. Take your wife out to, or your spouse, or out to a good dinner or something like that. That's the beauty of it. But
I agree. I mean, people have this.
What's the last advice you can give traders? Before we all go and call it a day, that they can take away today? Like, is there a great movie you watch, a great book that you recommend, or something that they could take away, not just registering and looking at your report, but something that like kind of helped you get to that comfortable market?
Yes. I mean, there's plenty of good books. There is, I think, like Trading in the Zone. Everyone has probably heard of that book. That's a good one. It's more the mental aspect of trading. I I would really encourage everyone to start to understand a bit more than just the charts. Listen, price action, it's the ultimate arbiter. Couldn't agree more. Anyone who says that, that's super true. But I think we're entering, as I said before, I think from my conversation with institutional investors, and we are entering an environment already where the why is going to start mattering more, not just the what, not just chart goes up. Because when markets normalize, and I don't think people realize a 15-year bull market with no volatility and almost no hiccups that lasted more than a couple months is not normal.
Yeah.
Right. And so I think the why is going to matter more. So start to learn more about than just the chart. From an intraday perspective, that matters a little bit less, but even there, right? Understand the algos. So go deeper and go beyond just you using a moving average and that kind of thing. That would be my 2 cents.
All right. Well, thanks. I love you 2 cents, because I made I made like 10 cents on that. But everyone, thanks for listening in. And Serge, thanks for coming in here. What time is it where you are right now? So you're in Zurich right now?
Yeah, I'm in Zurich right now. It's 6 p.m. I'm going to go home.
That is awesome. I just came back from Greece, and it was like 7 hours difference.
Yeah.
And I'm like, it's not that bad. I mean, like you have the whole day. Some of us day trading, we only day trade an hour in the morning. I'm like, it's great. You trade at 5, you're done at 6. You could have 2 jobs. You could hit the beach, go fishing, whatever it is. And
I mean, it's funny. Like, it doesn't matter whether I'm here or I'm in Florida with my other office. Like, my day is actually the same in terms of, like, I get up early, go to the gym, and I do a lot of the research. Except that I do a lot of the research, like in Florida, I'll do my research, a lot of the research in calls in the afternoon. Here, I do it all in the morning, and then the equity market opens at 3:30. We execute all our orders, whether it's on the investment side, advisory side, or myself, basically in the morning hours, New York time, right? So by 6, but like literally right now by 6 p.m., I mean, I'll go home and I'll do some calls and stuff, just business stuff, and maybe a research call. But other than that, it works well, man. You have to have. What doesn't work well is I can't do this in Asia because I focus on global macro and US markets, cash markets.
I've been there 3 times. I couldn't. It's 12-hour difference. It's totally like.
No, it's insane. You got to be like, this is a good, like, actually, I tell you what, probably my absolute favorite would be London, because that's 5 hours from the East Coast, right? Okay. So right now it's 5 p.m. there. So it's, you've got noon on the East Coast. That's right. I used to work a lot in London, and that was awesome because you had a lot of futures markets that you could trade.
Right.
You had Asia still, very, very little Asia, but you had to get the office early, but you had it. And then of course the US markets, it was awesome.
So you got the rest of the day, do whatever you want, like early in the morning, and enjoy it. That's awesome. Makes sense. Well, Serge, thanks for having us, being here. And then for everyone here, once again, click on that report, and we'll be back tomorrow. We'll have Larry McMillan on the podcast tomorrow. Looking forward to have him too. And make sure you subscribe to the channel. and make sure you subscribe to Serge's report. Serge, thanks for coming, and we got to definitely have it back again. It was great having you. I know it's been a while, and don't be shocked if I show up in Cirque because I've never been there. I want to go.
Yeah, come on over. Bring your skis or anything. It's nice here.
It is. Thanks for coming. Thanks
Thank
everybody
you,
for coming,
Fausto.
and we'll see you. And